As we move on now to the U.S., we wanted to look at some leading indicators or some insider views of what is happening of both internally within companies as well as other places. And so the big issue right now is insider selling. So typically you can say that insider selling is a trigger where they see things that are coming down the pike in terms of problems with their companies, what their internals are saying. So sometimes this is a bit of a leading indicator in terms of where things are going, and corporate insiders have been selling. In August, the ratio of insider selling to buying rose to the highest since February of 2,119 executives selling, most since November of 2021 on a net basis. So the question is, are we going to start to see this accelerating as prices come down? And typically this has been an indicator of health of a company, health of the economy, because they're seeing things prior to them being made public on earnings calls. So this is something to watch. Again, you can kind of see it's balanced out. I don't think it's giving much of an indication, but this is something that people look for. If I was an insider, I'd be selling. Obviously, I think the world is in a struggling place, and this is. But again, it's what sector are you in? Are you global? Are you just domestic? Because each one is going to have very different inputs and outputs. So that's just something to watch. And then taking that to the next level, looking at institutional open buys. And here you can see that there has been a fairly large purchase on the institutional front of puts. So people have been buying downside protection. There's actually a lot of open interest on September for expiry this month. And typically that can create a gamma event, especially if it crashes through, because you have people, the option individuals who sold the puts, they're going to be covering and trying to protect themselves to the downside, which can create a squeeze. Not to get into options Greeks, but again, it's just something that is going to be watched closely. But you're also looking at institutions. So typically, if you want to think of quote unquote smart money, this is normally an indication of where things are going and how things are shaping up. And you can see that this is the most puts interest or premium paid going back through to September 2020. So then when you look at what is happening at the consumer level, so we're starting to see some of that, an increase, a little bit of an increase in internal selling, some concerns on the institutional side. And an interesting backdrop here where as we come into total U.S. overdue utility balances, so more and more people have failed to pay their electricity bill, and there's an estimate that will be somewhere towards about 30 million people who have not paid their utility bills, and there's a chance it will be turned off heading into winter. So the question is, what is happening at this point? Is it really a risk because your prices went up, people were shocked by the prices, or is there something more behind it in terms of the health of the consumer, where they sit, and it's just people are trying to hold off and they'll resume paying as they get closer to winter, and they're trying to rebalance or rejigger really what they're spending on. It's something to watch, especially because there still hasn't been a huge mark to market in some electricity areas. And it's just depending on the contract. Is the mark to market every 3 months, 6 months, 8 months? Do you have a PPA that exists for several years? So as this matures and as you get a restrike, that's going to push power prices up again. And that's why when you look at this, we are nowhere near a slowdown in pain, and that's where the consumer is going to have to make decisions. And when you start looking at the adjustment of what things are spent on, this is obviously one that's going to be important heading into the winter months. Now, household electricity prices, as you can see, they continue to go up. The U.S. is still low, but then when you start looking at, again, compared to the UK, Euro area, and Japan, but we're still seeing that trend up for everyone. It's not just one or the other. Obviously, the U.S. has a lot of natural gas within it. There's the ability to consume as much as possible. But there's still a shortfall of pipeline capacity, especially the direction in which it's heading. There's a plethora in some places and shortages in others. It's just how do you balance that out? And Kinder Morgan was out today saying that there still needs to be about 20 BCF a day of new capacity coming online to move this product in the right direction, between now and 2030. And that's not to say that I disagree with it, because I don't. The question is, where is it really 20 BCF? Is it something? I'm sorry, 20% more, which works out to capacity will have to grow by more than 20 BCF per day from about 100 billion currently. So even though there's 100 billion, and you might say, well, we're only producing about 100 million barrels, 100 BCF, but how is it moving? Where is it moving to? Where is it being produced and shipped to? So there's a lot of stranded capacity. So they're saying that the Permian Basin in West Texas and New Mexico will need to move 10 BCF gas per day by 2030, with 7 billion coming from the Haynesville and 5 billion from the Marcellus and Appalachia. So again, there's a lot of this adjustment that has to happen. They're also obviously talking their book a bit, but I don't disagree. There is a lot of new capacity that still needs to be built on the gas processing side, which is why when you look at what we've been saying, especially in the FSC show and whatnot, is just the U.S. is going to grow on liquids and gas. That is where we're going to find that next tranche of demand. And I think this really fits nicely into kind of what we're saying and how we think that's going to play out. So then when we start looking at the average annual federal spending on clean energy, you see just the pivot that has continued from 2022 to 2027 with $79 billion now annual federal spending on clean energy. And it's just why we have to have a real conversation of, well, how do we make it not only clean, but maybe sustainable? If you have coal, can you put some mechanism on it? We've been looking at some different mechanisms that are amine systems. You can capture a lot of this flue gas. You can capture and process it into something else, taking a lot of that negative away from the stack, enabling for the ability to, again, deploy realistic solutions, but with a green bent. And not, saying everything has to be solar and wind, but it has to be a balance. What is the balancing act? What is the basket approach, which is what we've been honing in on. And while, it's good to see money being put towards infrastructure, we have to be smart on what type of infrastructure is it going towards, because we don't want what's happening in Europe happening in the US. And right now we are speeding towards that route at a uncontrolled pace. But there's still time to at least adjust. In California, we saw that there was all types of warnings not to charge your EV, reduce your consumption during peak hours, and it went down fairly quickly. But you don't want to get to that point. You don't want to get to those areas of stress, and where you get to in Europe, where now you're going to have to ration electricity, which again becomes that underlying problem, and then is obviously a huge anchor on your economic expansion. So then when you start looking at the separated by 3 quarters, a tale of two nations, household finances, and this is what we were trying to get across, because people have said on Twitter, it's like, well, things aren't as bad as they were in 2007. You've had a reshift in terms of how much leverage the consumer has, which is accurate. When you look, and the next chart talks about the home equity lines and how that is really well below where it was in 2007 and 2008. But things can change quickly, especially when you think about where inflation is, how much people paid for cars, what those rates are, how much that principal is. And auto delinquency happens to be kind of that early bellwether on the pain of the consumer, because typically people will stop paying their auto loans first. So this is just showing that pressure really starting to ramp up. You can see it's in the southern, a lot of the southern part of the country. But it's not just there; it's everywhere, and it's something that is, I think, indicative of that changing consumer sentiment, but really consumer finances. And as this ramps up, and people have to make a choice: am I paying my auto bill or my auto loan this month, or my electricity bill? And based on how few people have been paying their electricity bill, you're going to get that swap, and that's where you're going to get some of that additional pain. So now looking at household debt by category. So obviously student loans have increased exponentially. That has hit different families in varying ways. But auto loans is up 82% as of percent from Q3 of 2008 to Q2 of 2022. You have the total household debt is up 25%. Now, credit card is technically down, but when you but that is something that is this is for Q2. And when you see it come into Q3, because we have now exploded higher, we've now taken out the highs, from the pre-COVID lows. I'm sorry, the pre-COVID highs. Now credit cards are back in the positive. So yes, the home equity lines are down, but you still have a net amount of debt at a higher level. Interest rates are lower on it, but that is adjusting quickly when you start looking at where the auto loans sit at and where the credit cards are. So those two pieces, which we've talked about, have pivoted aggressively, and that's where we see a lot of that pain, especially on the credit card side, coming for the consumer and increasing those underlying issues. Now, when you start looking at why you're seeing those rates going up, it's obviously the Fed funds rate is still going higher. We're going to get, I think, more confirmation that it's at least a 50 basis point hike, likely something closer to 75. But bond volatility, it's still at these sticky highs. And look at where it sits and how sticky it's been at this 130, 135. The last time we had that was at 07 to 09 point. But there was obviously even more movement in there. You're just getting this very elevated level. And in order for the Fed to really knock this down, you saw rates getting cut. You saw QE starting to get pushed through because that helped cool that volatility side. And here we don't have those options. Instead, we're going the opposite direction, which is going to keep volatility elevated and why we continue to see an upward momentum in underlying rates. So this isn't being lost on anyone. When you look at the Goldman Sachs U.S. Financial Conditions Index, the 6-week percent change. So the retightening of financial conditions has been swift, with 6-week change in Goldman Sachs' U.S. Financial Conditions Index firmly positive again. And we see it moving up. And as that moves up, again, that just squeezes the ability of borrowing. And if you do borrow, the rate you're borrowing at. And again, that really impacts what people can spend, the going rates. And those are some underlying pressure points that we've been discussing and the problems that we continue to see. U.S. labor force participation rate bounced, went from 62.2 to 62. The survey was for 62.2, came in at 62.4. So again, people are coming back to the market. The civilian labor force by participation rate, that key 25 to 54, coming closer towards the pre-COVID level. And as more people come back to the workforce, unemployment rates technically will go up, but you should see wages come down a bit as you see some of that offset. Now, when we look at U.S. average privately hourly earnings, this is where participation rate going up, hourly earnings then start to cool off a bit. But as you have inflation still positive and wages now missing estimates and weakening, that's when you get the real wages getting hit and again shrinking purchases even more. And then when you look at the differences between the two, production and non-supervisory employees have been outpacing all employees. And it's just, again, where that pressure is, how you're trying to pay people to take these jobs. And that just gives you kind of that bifurcation that we've seen, which is why the higher earners aren't seeing the same wage growth, even though they're usually the ones that are driving the most discretionary purchases. Now, this is where it gets interesting because the household survey, the establishment survey. So when you look at the household survey, it's been fairly volatile, trending in one direction, but now you got this big pivot, and the established survey has slowed down a bit, but staying fairly consistent. So when you look at U.S. non-farm payrolls month over month, you get an idea of that fairly sizable movement. But the one thing that's interesting is what's happening in the household survey has never happened before in terms of this huge pivot in terms of flow. And just the sheer percentage increase, and that's where is there a big disconnect? Like, where is that disconnect? And that's where I don't know, and I'm not claiming to know, but when you look at this data and then you look at the Fed can use this as a means of it's go time. Like, we have to keep raising rates. The labor market can take it. The economy can take it. So we have to continue this path. At some point, we think you get that makeup and you get this big adjustment lower, but clearly it's been a lot of volatility, a lot of uncertainty. It could be just based on when people are getting announcements, because when you look at the Challenger job cuts, you see the headlines, companies are cutting. You're seeing more announced, but has it not filtered down all the way? Or are people are they just working 3 jobs so they're losing 1 and still have 2? So there's a lot of things to unpack, which we're going to continue to look at on the jobs front. Average hourly earnings came in year over year up 5.2% versus the estimate of 5.3. But again, as we've been saying, if it's up 5.2, but you still have inflation towards 8%, you're still seeing a negative drag on spending, which is why we continue to see those problems. Payroll diffusion weakened to 62.1% in August, lowest since January of 2021, as growth narrowed across industries. So again, there's another side of the equation where it's weakening on the payroll diffusion side. So you're starting to see, again, that narrowing piece in terms of where some of this is coming through. And that's where you get some of this disconnect. And sometimes when you have so much uncertainty in the market, you have so much volatility in the market, depending on who you're asking and when you're asking, is going to change the survey. And that's the problem with some of the survey data, because it can be very lumpy in points of very extreme inflation. And now getting to some of the key ones, which is PMI. So the JP Morgan Global Composite PMI reports global economy contracts for first time since June 2020, despite further easing in cost inflation. The title now reads since 2022, and again, it's just a matter of when that, because again, remember 2022 is when it happened, not 2020. You've had some of that movement, but now when you look at August ISM services, up to 56.9 versus the estimate of 55.5. New orders were up to 61.8. Prices paid down slightly. Supplier deliveries moved lower, and inventory sentiment dipped back into contractionary territory. Employment now expanding even so slightly. The U.S. services sector either expanded or shrank faster in August than in July, according to the 2 separate business surveys. The Institute for Supply Management on Tuesday said the nation's services grew faster in August than in July, an index that tracks industries including healthcare, finance, ag, and construction. Separately, the S&P Global said on Tuesday the services sector shrank faster in August than in July due to weak demand, according to the Services PMI Business Activity Index. So when you start looking at the different pieces, there's different representation. So representatives for the 2 surveys said their results accurately portrayed what is happening. For the services index, the ISM polls company purchasing managers, while the S&P Global also surveys other executives. The ISM surveys a larger set of industries, including construction, mining, utilities, and government, that the S&P excludes. So the question is now, is it a matter of executives feel worse and that's what dragged it down, or government and mining guys and construct and utilities feel better because of what they're seeing? Because if you look at utilities, prices are going up. Mining, my God, like any coal mine you could find is in the money, and government, is fairly stable. So that could be some disconnect. So then when you look at the ISM services, to put it into perspective, employment is still at that kind of flattish range, which is why the employment data still looks odd. But then you look at ISM services and you're like, okay, well, why is that there? So then when you start breaking it down based on employment, so while employment diffusion index has rolled over, employment components within both ISM manufacturing and services have ticked up recently, both into some expansion. So is that some of the makeup where some of that labor data is coming through, you had some of that benefit, and now it's gonna die off as we go through September, because you do have some late hiring for schools, you have back to school activity, things are starting to normalize a bit. So I think September is going to be an important month to see, okay, well, the trend did shift, things are getting better, or that was more of a fluke, things have outperformed to the downside now, and it's going to continue to weaken as we go into the winter months. Now, this is looking at Pantheon's macroeconomics. So they choose ISM, probably, just throwing out that nice fun thing, between S&P Global U.S. Services and ISM. They're saying that ISM is the better view, but then others are going to say, well, S&P Global really is because ISM has more noise. But when you look at the data sets, they each have had different peaks and troughs, but they usually end up in the same direction. So the question is, I would say they're both wrong and they're going to meet somewhere in the middle. The question is going to be, do they meet somewhere in the middle above 50 or below 50? And because there's so much push back and forth on which one matters more, that's where you kind of have to look at, okay, well, is this really going to drive higher? We, based on other inputs and what we're seeing in other areas of the U.S. economy, we're assuming that it's going to meet something closer to 50 and really have a negative trajectory going into October as it did coming into September. So again, that's where we kind of shake things out, where they're both going to be lower. It's just they're going to be closer to 50, not still not below in general. Backlog of orders for the ISM services came down. Prices paid normalized, but still obviously elevated, which is what we continue to see is that kind of flatlining. You're starting to see the rate of change a bit, and something that we think, because it was only a slight decline, something that we think holds in. But backlog of orders is coming back down. Then when you start looking at new orders, that had a nice spike. So it's just a matter of, okay, well, is it just because of the timing? Is it something where a lot of stuff had gotten canceled, now it's coming back, that prices have gotten a bit better, and employment inched to growth. But if you look at it, again, we've been saying it's just going to bounce around 50. It's going to be between 49, 51, and then that's where there's a certain margin of error where we're comfortable in saying employment is flat. It hasn't gone up, it hasn't come down. We think it's going to edge to the downside, but again, nothing happens aggressively, and that edge to the downside is not going to be like we saw in 08 or in 2020. If we go to 30, it's going to be slow, and something closer to 48. We do think we get a bigger drop off, but that's going to take a bit more time. Now, when we turn to the PMI service business activity, when you look at the negative growth, so U.S. service PMI final read came in at 43.7 versus the initial print of 44.1. Companies recorded solid decline in new business, with new orders falling for the second time in 3 months, contraction among fastest on record. So here's when you look at incoming new businesses down, and that's why it's a matter of, okay, well, who saw new business? Was it the mining companies that they don't cover, which drove that? Which would make sense given the fact that it's mining, but mining is such a small part of the global economy. Is it really going to move the needle higher for the S&P 500? It's great if you're in energy. It's great if you're in things that they move physical stuff, but that's where you start to see some of these different shifts. Now, ISM manufacturing was expected at 51.9, came in at 52.8, but the production came much further down to 50.4. So again, another drop closer to really that margin of error where we can say production was flat and manufacturing, as we've been saying, so if you remember, we thought services was going to go negative and that PMI was manufacturing was going to hold in. So if you want to take the mixture of the two, we were either really right, or if you want to use just ISM, we were right and wrong. So it just, you can choose your data set to push against us. But here is where we do think things slow a bit, but still remain an expansion on the ISM manufacturing side. And really new orders were expected to be at 48, came in at 51.3. But export orders came down and are now contracting. So it's just a matter of we're seeing a bit more, again, internal, preparing for Christmas, preparing for the holiday push, where exports we think are going to continue to roll over, but the new orders in general are just going to bounce between, again, something similar where that margin of error, depending on when you ask, is it 49? Is it going to be 51? Is it somewhere in the middle? And that's where we think that right now there's no real trend outside of flattish with either minor growth, minor expansion. Then when you look at employment, there was a nice recovery from 49.5 to 54.2. Prices paid came down from 55, expected 55.3, came in at 52.5. So a nice little bounce, but when you look at the employment side, but you can see it's still kind of tracking within this tight band. Prices paid, again, leveling off here. The question is now going to be, as supply chains have caught up, where do wages come through? Do you start to see that with employment going back up, wages going back up, which is going to keep a bit of a floor on the prices paid side? Now, when you look at the recession versus ISM manufacturing prices paid index, it's a good thing to see prices paid in ISM manufacturing rolling over swiftly, but quick collapse, typically closer to the minus 30 mark for the 6-month change, has often preceded recession. So is it also a bit of a harbinger of what's coming, where you're starting to see some of this pressure, you're starting to see some of this pain, and that's going to be an interesting one to watch. And again, I think that more and more things, as we've been saying, point to a recession with some reacceleration in August, but again, a firm still downtrend as we head into September. ISM new orders minus production. The spread between new orders and production components within August ISM manufacturing bounced back sharply. Not yet a definitive trend, but obviously it's an upward move. But you can see that there's typically these sharp moves off the bottom, and then usually when you get that sharp move off the bottom, you kind of go sideways. And there was obviously in 2009 there was over exaggeration to both sides. But I think at this point you had a lot of backlog, you had a lot of normalizing on the supply chain, and you're going to get a lot of this leveling off at this point. So then here, U.S. construction spending slowed, again, kind of showing some of the pressure that we've been seeing. Came in minus 0.4% in July, slightly better than minus 0.5 in June, but second consecutive month of contraction. Obviously, residential continues to be the driver of a slowing in private construction, as non-residential is fairly flat. And we think that, again, you're going to get that movement down as the construction spending is going to be driven by residential slowdowns. And then this is just putting into context, the construction spending for private residential has contracted for 2 consecutive months, which hasn't happened since the depths of the pandemic. And again, just pointing more towards, because if you look at the trend, so when you look at 2020, you had a big move down, then a smaller move, and then you were back to positive. And here, just like in 2018, you're having that negative trend move to the downside. So again, we still see more pressure moving on the construction front. And then, as we said before, July factory orders came in at minus 1% versus the estimate of 0.2 in July. Orders ex transports coming down. So when you look at August is going to see a bit of a acceleration, but even when you start factoring all of these in, you're above 50, below 50 on the PMI side, you're still getting more of a flatlining with a downward bent, which is really where we see this accelerating to the downside, and especially as we go into year end. Mortgage applications fell for a 4th consecutive week. We have only had 10 positive readings since the beginning of 2022, which again is a leading indicator and more pain ahead for the real estate side, which is again a leading indicator for some of the pain that we expect to see in some of these other areas. When you look at direction of home prices moved in the last month, the U.S. housing collapse is where I won't call it a collapse, but the slowdown is accelerating. You're seeing that there's more and more decreases. 35% of homes saw a decrease, 45% were flat, with 20% an increase. So again, moving in the wrong direction, and we still see that again signaling that slowdown. Now, there's no notable move up in mortgage search activity, but when you start looking at some of the different spikes in earlier days of pandemic, we're met with serious pullbacks. So again, we're still just seeing kind of this flattish move, but we do see that real estate side continuing to come under pressure and show that slowdown. So that's what we have for you for the U.S. In the next segment, we're going to go deeper into Europe and what are some of the things happening there.